Hey everyone, ready to unpack some market predictions for 2025?
Always.
Okay, good, me too. We've got this fascinating report. Actually, it's translated from Chinese.
Oh, wow.
Yeah, so it's giving us a different perspective than just like the usual Wall Street stuff.
That makes sense.
But what's really interesting is that it also looks back at 2024 predictions.
Oh, really?
Yeah, so we can see like who actually got it right.
So it's like a track record.
Exactly.
Yeah.
So it's not just about what's predicted, but like who's making the prediction, which is pretty cool, I think.
Yeah, for sure. Adds a whole other layer.
Yeah, for sure it does. But before we jump into all of that,
Yeah.
we have to talk about the Fed, of course.
Of course.
What have they been up to lately?
So their last meeting,
Okay.
they did cut interest rates again by 25 basis points.
Okay, so that's 0.25% for anyone who's not familiar with basis points.
Exactly.
Okay.
But
Yeah.
the minutes from the meeting made it seem like they're going to be a little more cautious moving forward.
Really? So no more of those big, aggressive rate cuts.
Seems that way. Yeah. They seem pretty confident about inflation in the job market right now.
That's good.
Yeah.
But wasn't the market expecting another rate cut in December?
Yeah, there was definitely talk about that.
And is that maybe tied to, like, the election and everything? Potential new policies, I mean.
It could be. Some people are definitely worried that some of those policies could, mess with inflation.
Right, like if tariffs come back.
Exactly.
Yeah. It's always that dance between politics and the markets.
Always.
So what's the overall outlook for rate cuts now, till the end of 2025?
Well, the CME data is showing that the probability of a December rate cut has gone down to 60%. And it could keep going down. The market's now only expecting maybe 2 or max 3 rate cuts by the end of 2025.
Okay, so less aggressive than before, but not totally slamming on the brakes either.
Exactly.
Okay, so now for the fun part, the 2025 predictions.
Okay, you ready for this?
Hit me with it.
OpenHammer.
The ones who got 2024, right?
Yeah, pretty much.
Yeah.
They're raising their target for the S&P 500 to 6,200 points.
6,200, that's quite a jump.
It is.
What's making them so optimistic?
Well, they say it's strong economic fundamentals. Corporate performance is expected to remain solid.
Okay.
They even mentioned that the election kind of removed some uncertainty, which could lead to more stability.
Interesting. So they've got reason. It's not just like gut feeling.
Right. They have data to back it up.
Okay, but is everyone else like as bullish?
Deutsche Bank is.
Oh.
They're predicting a 17% surge, putting their target for the S&P 500 at 7,000 points.
7,000.
Yeah. They're banking on continued high investor demand, a surge in company buybacks,
Okay.
and, of course, you can't forget the possibility of tax cuts.
Oh, right, of course, the tax cuts.
Always a factor.
Always. But are they like completely ignoring any downsides? I mean, 17% seems like a lot.
They do acknowledge some risks.
Okay, good.
Like concerns about protectionist trade policies.
All right, yeah.
And how that could impact global trade.
Makes sense.
And also immigration policies.
Yeah, that's the big topic.
Yeah, they're suggesting that if those policies get too restrictive, things could go south.
So a little bit of cautious optimism, even though they're super bullish.
Exactly.
Now, what about everyone else? Same kind of predictions.
Well, BMO, the Bank of Montreal, they're a little more grounded. They're forecasting the S&P to reach 6,700 points.
Okay, still a jump, but not as much as Deutsche Bank.
Right.
Why the difference?
They're taking into account the historical trend of the third year in a bull market being a little weaker.
Okay.
However, they still believe we're in a bull run, and they encourage investors to not get too caught up in the potential downsides.
That's good advice.
It is.
So far, it's mostly bullish, though. Anyone bucking the trend?
Well, RBC is a little more cautious.
RBC?
Yeah, the Royal Bank of Canada.
Okay.
They set their target at 6,600 points. They're anticipating some short-term corrections because of, all the uncertainty with the new political landscape.
Right, maybe it's
And Bank of America is aligned with them, predicting 6,666 points, but they're really stressing the importance of being selective with stocks.
So not just blindly following the market out.
Exactly. They say focus on individual stocks that are well-positioned to benefit from the new policies and the overall economic cycle.
Yeah, that sounds like solid advice.
It is, and they're particularly bullish on certain sectors like financials, consumer discretionary, materials, real estate, and utilities.
Makes sense. Okay, so we've heard from the folks who got 2024 right.
Right.
But what about those who missed the mark? What are they saying about 2025?
Oh, that's where things get really interesting. JP Morgan, who had the least accurate prediction last year,
Uh-huh.
they haven't released their 2025 forecast yet.
Oh, wow.
Maybe they're being extra cautious this time
I
around.
can imagine. But get this, Michael Wilson from Morgan Stanley, okay?
You know, the guy known for being, like, Wall Street's resident bear?
Yeah.
He's done a complete 180.
Really? Mr. Doom and Gloom is turning bullish.
He is. He's now predicting the S&P will hit 6,500 points. He thinks the election could actually lead to a surge in corporate investment and confidence, partly because of a potentially less strict regulatory environment.
Wow. That's quite a shift.
Mm.
And the other analysts who were off last year?
Wells Fargo and Goldman Sachs,
Yeah.
they've both turned bullish, too. Wells Fargo is targeting 6,600 points, while Goldman Sachs is predicting 6,500.
So even the skeptics are hopping on the bandwagon.
Looks like it. They're both optimistic about the new political landscape and its impact on the economy.
Okay, so lots of bullish predictions, even from those who were wrong last year. Now let's circle back to that Chinese report.
Oh, yeah, that's what we'll delve into in part 2.
Perfect. I'm excited to see what they have to say.
They have some really interesting insights, especially about being cautious amidst all the excitement.
Okay.
And they really emphasize looking beyond just the short-term market stuff.
Can't wait.
Stay tuned.
We'll be right back after the break. All right, let's dive back into that Chinese financial report. I'm really curious to hear what they have to say, especially with all those bullish predictions we just went through.
Yeah, it's a good reality check.
Exactly.
So this report, it kind of echoes the overall bullish sentiment, but
Yeah.
it definitely adds a layer of caution.
Okay, I like that. Hit me with it. What do they say?
Well, one of the first things that jumps out is they say, don't short the market.
Wow. Really?
Yeah.
That's pretty bold considering everyone seems to think 2025 is going to be a good year.
Right. It seems counterintuitive, but when you look at their reasoning, it actually makes a lot of sense.
Okay, so what's their logic?
They basically argue that the U.S. economy is fundamentally strong
Okay, yeah.
and that the medium to long-term outlook for stocks is still positive.
So they're not like predicting a crash or anything.
No, not at all. They're just saying don't bet against it in the long run.
So even if there are like some bumps along the way?
Exactly. They're saying shorting the market, especially now, it's just too risky.
Okay, I got it. But, I'm sure a lot of people are thinking about what about a correction?
Oh, yeah, that's a valid concern.
Right, because bull markets have those ups and downs.
Absolutely.
And those dips, even small ones, can be scary. What does the report say about handling those?
Well, they advise against panicking. Like, don't pull out of the market if things get a little shaky.
Easier said than done. It's hard not to react when you see your portfolio dropping, even a little bit.
Oh, for sure. It's natural to want to protect your investments.
Right.
But their point is that bailing out during a correction, or even worse, shorting the market, could actually hurt you more in the long run.
Yeah, because you could miss the rebound.
Exactly. And here's where their advice gets interesting. They say, shift your focus away from the overall market and start being more selective about individual stocks.
So not putting all your eggs in one basket, even if it seems like a really good basket.
Precisely. And they're specifically concerned about the hype surrounding certain companies.
Oh, I see where they're going with this. They're talking about the companies with like really high valuations, but maybe not the strongest fundamentals, right?
You got it. They actually call them purely speculative stocks. And they warn that those are the ones that are most likely to tank if we do have a correction.
And those losses, they might not come back, right? If a company doesn't have good fundamentals to back it up, it might not recover.
Right, that's the risk. And they're actually suggesting that a correction, at least a short-term one, might be coming soon.
Okay, so that's a little unsettling. What should people be doing to prepare?
They recommend taking a look at your portfolio and figuring out which stocks are truly strong and which ones are just riding the hype train.
Okay, yeah. See what needs to be rebalanced.
And then start taking profits from those overvalued stocks before a correction hits. Gradually, strategically.
Basically cashing in on those inflated prices while you still can.
Exactly. And they suggest taking that money and putting it into companies with really solid fundamentals.
Makes sense. Any specific companies or sectors they mention?
They mentioned major tech companies.
Okay.
And also cyclical stocks. They see those as potential safe havens during a correction.
Interesting. So the key is being strategic, not just making decisions based on, like, fear of missing out.
That's exactly it. Be bullish, but be smart about it.
Love it. Don't just follow the hype. Do your research.
And that's what's great about this report. They encourage readers to make their own predictions, for the S&P 500.
Oh, that's right. They actually want people to engage with the information and come to their own conclusions.
It's about taking ownership of your investments and making decisions that fit your situation.
I love that. So we've covered a lot of ground here. Interest rates predictions, warnings about speculative stocks, and some solid advice on how to navigate those potential corrections.
Absolutely.
But before we wrap up, I want to bring it back to our listeners. What does all of this mean for them? Everyone listening right now, what should they be doing with this information? How does it apply to them?
Well, that's what we're going to talk about in the last part of this deep dive. We're going to connect all of these market predictions and insights back to your personal financial goals.
Perfect. I'm looking forward to it.
We'll be right back.
Okay, so we've talked about all these predictions, but I think it's really important to remember that everyone's situation is different.
Absolutely. And that's why you got to think about your own financial goals.
Yeah, exactly.
Like, what are you saving for? Retirement? A down payment? Maybe starting a business?
Or that dream trip you've always wanted to take.
Exactly. Because those goals are going to determine, how much risk you're comfortable with.
And what your overall strategy should be, right?
Exactly. If you're in it for the long haul, like thinking about retirement, then those short-term market swings, they don't matter as much.
Right. But if you're saving for something sooner, like that down payment,
then yeah, you got to be a bit more cautious.
and that's where those warnings about speculative stocks come in.
Right, totally. You don't want to get caught up in the hype and then the market takes a dip.
Ouch. Yeah. Nobody wants that.
It all comes down to understanding your own risk tolerance. Like, are you okay with maybe losing a little bit in the short term if it means bigger gains later on?
Or do you need something more stable, more predictable?
Exactly. It's a personal choice. But it shouldn't be driven by, like, FOMO, the fear of missing out.
Right, right. Make decisions based on what makes sense for you, not what everyone else is doing.
And I really like how that Chinese report, they actually encourage people to make their own predictions.
Oh, yeah, that's a good point.
It's not just about listening to Wall Street. It's about actually engaging with the information.
Yeah, and forming your own opinions.
And then using those opinions to make decisions that align with your goals.
Exactly. Because by doing that, by researching and analyzing and predicting, you're learning so much about the market.
And you're developing your skills as an investor.
It's like, instead of just being handed a fish,
Yeah.
you're learning how to fish.
Love that analogy. And that's really what we try to do here on the deep dive,
Yeah, for sure.
We're not just giving you the predictions, we're giving you the tools to think for yourself.
Exactly. So as we wrap up this deep dive into those 2025 predictions, remember, there's a lot of optimism out there.
Yeah, lots of bullish energy.
But don't let that make you ignore the risks, Do your research, be selective, and don't be afraid to think differently.
And maybe even go against the grain a little bit if it makes sense for you.
Exactly. Make it your own. And most importantly, keep learning, keep exploring, and as always,
keep diving deep.
That's it for this episode, everyone. Thanks for listening.